Well, welcome everyone to the monthly market update from Principal Wealth Partners. We are in June of 2023. I'm Julina Ogilvie, partner and wealth advisor here, joined again with Bob Paolucci, our founder and CEO. Bob, welcome.
Good morning, Julina.
So we are, I can't believe I'm saying this, but we're halfway through the year. And I would love to remind everyone that we have been saying for almost 6 months now that 2023 would look very different than 2022. And so far that has transpired. And I think the big question that everyone's asking is it sustainable? So our agenda today that Bob, I know you're going to go through this in a moment, is really to talk about some of the key topics that we've been addressing over the months, whether it's the Fed, the debt ceiling, earnings. We want to talk about the characteristic of the market so far this year, and maybe give a hint to everyone that we think that that's going to shift for the second half of this year. And then maybe touch on some of what the media is still talking about in regards to the banking crisis, commercial real estate, and this looming recession that we've been talking about for so long, if that's fair.
That's fair. Yeah, this video and presentation is going to be filled with a lot of good news, a little bit of confirmation bias about some things that we've been saying late last year, early this year. We might as well just jump right in. How about that?
Go for it.
Okay. Here is if you've been watching these videos, our laundry list of things that we've been looking at. Number one is the Fed, right? We had mentioned last month that the language sounded like a pause pivot going forward. We're sticking to that. We'll cover that. We think the Fed is done. They ended their rate hike experiment last month. We think we reached their terminal rate. We say that because the forecast that they put out for interest rates and the current level of which they brought interest rates to matches. It's that easy. We'll get into that. We'll talk about the depth and breadth of the market. We'll explain that there are only really a handful of companies that have led the way so far this year. Very normal in the beginning of a bull market. We'll talk about earnings. One of the reasons why we have a bull market. The debt ceiling we will no longer be talking about. Hooray for us.
Can we take that off the list?
Yes, we will going forward. So as we had mentioned, the U.S. has never defaulted. Debt ceiling stuff is really political theater. And once again, it has proven to be that case. It's political theater. There was some negotiating, a little give and take, which is what you want. And it is no longer an issue. Well, at least it's no longer an issue for this year, next year. Potentially it'll pop up again in 2025. We won't even cover it after these talking points. Goodbye bear market, hello bull market. So last night on the market closed up 20% from its low on October 12th. We'll cover that. It is something that we had talked about seeing sometime this year back in our January yearly outlook. And then we've talked about it monthly since then. So here it is. It happened. A few tidbits on the banking crisis. It's not really a crisis. Banks, to solve their own problems of holding on to deposits or holding on to money, they decided just to no longer lend money and the impact that that will have in the economy. And then, we think there might be some issues in commercial real estate. More so for private investors. Eventually, that will be an opportunity. For now, it's a headwind, at least to that market, the private market, the real estate market, more so commercial real estate. And then, of course, we will always talk about a recession, especially when the headlines are mentioning recession. Europe actually went into a recession. We heard about that this week. We think it will be difficult for the U.S. to go into a recession, but we'll get more into that. How does that list of topics sound?
It's a lot, but I think it's incredibly important, and I'm just excited that some of these are getting knocked off the list next month.
Absolutely. So here we have the expectations for the June Fed meeting, which is next week, Julina. I think what's interesting about the timing of this meeting next week, the Fed meets for 2 days, Tuesday and Wednesday of next week. The inflation number comes out on Tuesday, and that will certainly influence this decision. But here are the Wall Street betting odds, as can be seen through the Chicago Mercantile Exchange, where investors bet on the probabilities for a rate hike, cut, pause, so on and so forth. And what you see right here on the screen, this wonderful slide, is that there's a 72.4 chance of a pause. So one would say if pause doesn't happen, that would be a surprise. The Fed is not in surprise mode. They haven't been. And I don't think they are going to deliver a rate hike. I think they are done. And I think the language, again, going back to last month, articulated subtly that they were done increasing rates at the last meeting.
So despite the fact that the Fed hasn't said they're done, the market is anticipating them to be done.
Yeah, they don't ever say that they're done.
Right.
They just say we're watching.
Yeah.
And we'll act if we need to. And I mean, if you're at home and you're interested in this stuff, read their prepared statement, which generally speaking is just a slightly modified version of their prior statement, which generally speaking is a slightly modified version of their prior statement. What's interesting about the last statement we mentioned on the last video is that we've seen more changes than we've seen in about a year to the prepared statement last month versus the month prior.
Right.
And the language change was around going forward. We will focus on the data. We think we reached a restrictive level, and any additional tightening will be based on incoming data. Where the prior language said we are still on a path to, higher interest rates, so on and so forth. So that was the change. Jerome Powell even referred to it. Again, he doesn't want to, in the press conference, have little snippets of him saying that it's over, we're pivoting, we're cutting, so on and so forth. So they will do that stuff subtly through the printed language. So again, we think the Fed is done, which means the next move is likely going to be lower. Now the question is eventually going to be: is it going to be before the end of the year, or are they going to do what they have forecasted in writing, which is cut interest rates by a full point next year, which is in their current print, by the way, starting in the first quarter of next year. We'll see.
Right.
We'll see. But the market has a way of reacting to the future.
Yeah.
More so when it's in writing. So as we get closer to Q1 of next year, and the Fed's still saying that their path is lower, the market will very likely start to do this.
Great.
So anyways, the inflation story is about to end. Oh, thankfully. We've been passionate about time being the killer of inflation. We've been passionate about inflation, this inflationary period being infused by a massive creation of money, a massive handout of the creation of money, a massive spend of free money, right? Generally speaking, in life, you'll spend someone else's money before you spend your own. So think about the trillions of dollars that were handed out that weren't expected to be received by all these people. And that's over. That's over. So, of course, just give it time and you'll see things trend back to normal. Mind you, this was during a pandemic, so supply chains were disrupted. But here we are with inflation rolling off for soon to be 12 consecutive months, declining for the first time in history. We believe it'll be 13 consecutive months, again, for the first time in history next month. But this month, next week, we have almost a full percentage point of inflation rolling off. You see the May 22.9 is rolling off. We believe there'll be a zero point 0.2 or 0.3 rolling on. We also believe that the June inflation that rolls on will be 0.2 or 0.3. That number, though, is the single highest inflationary number we have had in greater than 40 years, 1.2%.
Amazing. Yeah.
So that's going to roll off and be replaced with maybe a 0.2, maybe a 0.3. So that's a full point coming off of inflation. Why does that matter? Well, the inflation rate right now is 4.9%, and we are about to have potentially 1.5%, a point and a half of it rolling off. In essence, a quarter of inflation is going to be cut off, the annual number, in the next 2 months.
Yeah.
Now, I'm going to go on record and say, for the second half of this year, we think the three, either the high 2 or low 3% inflation is going to bounce up and down to generate a net sideways move through the end of the year.
Right.
So we think, the 12, soon to be 13 consecutive monthly declines are going to turn into more of a sideways
And I
choppy.
think a good example of that is the July number, right? Which is 0 of last year, right?
That's
When
correct.
that rolls off, whatever rolls on, again, that's part of that rolling wave.
That's correct. Now, one thing that's really hard to forecast is the 1/3 of the inflation number that is housing. Housing has about a 1 year delay, the way it's calculated, in reflecting the current environment, right?
Sure.
It's so stale that it might reflect the wrong environment.
Yeah.
So housing, which really has artificially kept inflation high, is going to start to roll off. It's actually already starting to roll. It's coming off of a very high mark and it's starting to roll. There is a good chance that we hit the 2s sometime this year, assuming that housing number reflects what's really going on soon.
Yeah.
So more to come on that. It gets a little tougher to forecast. I'll have a lot less conviction and a lot less passion when I talk about inflation for the second half of the year. So more to come on that. So stay tuned. Inflation's coming down. Don't be shocked like the people on TV are shocked when the number comes out and they say, wow, how did we go from 4.9 to 4.2 and 4.2 to 3.3? You can just tell them, well, it's math.
Right.
Anywho, Julina, how about this market, the S&P 500?
I know, the Magnificent Seven. It sounds like some sports team.
Tell me more about this, Julina.
Well, I think, we talked a lot about the markets being different this year in 2023. And we had a lot more optimism for the second half of this year with the equity markets in particular, as we got through the debt ceiling, the Fed language, and earnings. Yet, the markets have done well this year, but in a very concentrated way, hence the Magnificent Seven. Is that a fair way to say it?
Fair way to say it. So you look at the S&P 500, which we would tell listeners is really the market. The Dow is 30 stocks weighted by stock price. It's an irrelevant index. It's the big number index that people watch. They refer to the Dow 32,000, 34,000, so on and so forth. It is an irrelevant index. Every Dow component is inside of the S&P 500. The S&P 500 is the index of the largest publicly traded U.S. domiciled securities, sorted by largest to smallest. That's it.
Yeah.
So those 7 companies listed, Facebook, Amazon, Facebook is Meta, by the way, Amazon, Apple, Microsoft, Google, Tesla, and NVIDIA, those 7 companies glued together have gone up 53% since the bottom, in essence, right? The S&P is up about 10 or 11%, but 493 of the 500 companies in the S&P 500, therefore, the rest of the S&P 500 minus those 7 companies have returned 0 this year.
Right.
So you have an incredibly top-heavy market, and that is normal at the beginning of a bull market. There's always one sector, one group one style, one factor that brings you higher first. And in this case, it is the tech companies that have some connection to artificial intelligence. It just so happens that those companies happen to have huge market values, big moats, lots of cash on hand,
Mhm.
um, complete access to capital whenever they want, at still very low rates.
Mhm.
Um, and it's those mega cap companies that, again, have pulled this market up. I don't love a market that is led by seven companies. I would like to see participation by many more. We're going to get it in the second half of this year. So it's very likely those companies, for the second half of the year, they might still go up, but not as much as they've gone up, maybe for the past 6 months or so.
Yeah.
I believe the non-participating sectors, there are only three sectors of 10 that are positive in the S&P this year. I believe the negative sectors are going to bring us higher.
Yeah. And I know you're gonna talk about the concentration, but also, and this is maybe a good segue. These seven companies were basically pummeled last year.
Really? There you go. So yes, don't get too excited. People, it's funny, the emotions of investors, they get very excited when things go up and they want to buy things after they've gone up, right? So for our investors, right, for our clients, everyone at the firm owns these securities through either the active funds that we have, the passive funds that we have, ETFs, and in some cases individual securities outright. So our clients have participated. um, Sometimes you forget, well, you can't have one of these as 70% of your portfolio. If you did, well, let's just look back to last year. The seven companies that are up so much this year, well, last year, Tesla was down 65%. And I should mention that most of that decline came in the last 60 days of the year. That's a rude awakening.
Mhm.
Let's see. Facebook was down 64%. Nvidia was down 50. I mean, we're talking about having the value of a security.
Mhm.
Amazon was down 50. Alphabet was down 39. Let's see. Microsoft was down 28. Apple was down 26. All of them underperformed the S&P 500.
Right.
Most of them underperformed the NASDAQ, and the NASDAQ was down 34% last year. So, these are spicy. And they really forced the market down last year. This year, they're helping the market up, or they're propping the market up, or buying time for the rest of the market to find its footing, to
Mhm.
create a deeper, broader, wider market, which is what we're looking forward to. Um, but it's worth talking about. So,
Yeah.
um, it's interesting. You hear a lot about the concentration of the S&P 500. I found this chart to be very interesting. This is a chart of the weight of the top five of the S&P and the weight of the top three, the red line. And then in order of largest to smallest, the symbols of the largest five throughout the years.
Mhm.
So, you go back to mid 97, the S&P 500 leaders, the biggest weights, the biggest companies in the United States: GE, Coke, Microsoft, Exxon, and Intel. Wow. I mean, they're still big companies.
Mhm.
Apple is, with the exception of Microsoft, Apple is bigger than Exxon, Intel, Coke, GE glued together times two. And then you fast forward to the beginning of 2000, it was Microsoft, Cisco, GE, Intel, Exxon. So not too much change, but Cisco found its way in. Cisco at that time had negative earnings. You remember that, right?
Oh yeah.
Yeah. Um, you then fast forward to '08. It was Exxon, Walmart, Procter and Gamble, Microsoft, J&J. You fast forward 3, 4 years later, Apple, Exxon, Walmart, Microsoft, Google. So now you're starting to see, the zero rate environment, a growth on environment here, push some of these tech companies up, non-tech companies down. Then you had 18 with Apple, Amazon, Microsoft, Google, Berkshire Hathaway.
Mhm.
So here we are with, I'll give you them as of today because they are not listed as of today. So, Julina, if we look at the today's top five, and
Yep.
you can see on this chart that the concentration in the top five companies right now is maybe a shade over 25. So let's call it 26% as of 526. 26% in the top five of the S&P 500. Here are today's top five: Apple, Microsoft, Google, Amazon, and Nvidia.
Nvidia. Okay.
Nvidia, not far behind Tesla, number six on
Wow.
the list.
Yeah.
Um, so
And
you
I
can
think
see,
people sometimes are surprised as to how recent Amazon hit that top.
uh, true,
Yeah.
true, yeah,
But a great example of how these move around, but yet that concentration, especially really since 2018, it just continues to increase.
that's right.
Yeah.
Yeah, Amazon and Apple and Microsoft and Google, sorry, they are the trillion-dollar club. Apple and Microsoft are the $2 trillion club. Apple actually, if Apple has a good, if Apple hits $200 a share, it's a $3 trillion company, which is just amazing.
Wow.
Um, Apple's market cap is larger than the economic output of about 80% of all countries.
Right.
I mean, it's just an
Unbelievable.
enormous, trusted, high quality company. So
Yeah.
figured we share that. So here you go. Highest market concentration over 15 years. Percent of stocks outperforming the S&P 500. So the percent of the S&P 500's guts, in essence, the making of the S&P 500, the securities within the S&P 500,
Yeah.
percent of the securities outperforming. Very low. So it is a tiny group. Just shows it again. This is overkill, but it
And
just shows you again that the market right now is super, super, super concentrated. So if you own a value, if you're a value investor, and we have, certainly some good exposure to value investments, which are in essence sectors in the S&P 500 that are focused on dividends, free cash flow, quality, all that stuff. They are light on AI related themes and technology. They are slightly positive. Some are slightly negative year to date. It's just because the sectors aren't growth.
right.
So that will catch up pretty soon. But for the first 6 months, you are seeing that tiny amount of securities within the index are doing the work of the index, in
Of the
essence,
index, yeah. And
making
I
it run.
have to add, if you hover over 2020, that was when we started these webinars and we started talking about the markets. And that number at the time, I remember clearly being just shocked as to how it was concentrated, and look at it now
Yeah.
compared to back in 2020. So it's just amazing
Yeah,
how it's
historically,
changed.
to give you normal data here on the S&P 500, a very deep, diversified, wide market really means you have anywhere between 45 and higher percent of the holdings of the S&P outperforming the index.
Mhm.
That's a very deep market. It doesn't mean it's a bad market if it's less. It means there's something going on, something unique. There's a singular theme,
Mhm.
or there's a lot of concentration in the market when you see levels that are below 40%. And so far this year, the year's not over, only about 27% of the actual market is outperforming the market.
Yeah,
We don't love that. And we think the second half of this year, that data point will change where there's a lot more.
exactly. Great.
So more to come on that. Earnings continue to go up, right? So the stock market looks forward. It looks beyond the trees. The economy and the data that you hear reflecting the strength of the economy looks backwards. Why? Well, the economic data reports are anywhere between 1 and 3 months old. Earnings forecast, well, forecasting is the future. The stock market looks at the future. The economy is looking backwards. The economy and the stock market are not the same. They are roommates in the same condo complex. They are not related. They just, know each other well.
Yeah.
And they do totally different things, but they do live in the same neighborhood. I would even say in the same building, but they do very different things. They have two very different lifestyles.
Yeah.
That makes sense? So
Yes.
don't get upset when you hear the stale economic data reflecting a weakening economy.
Mm-hmm. Yeah.
Look to the other side of that. And if you hear things like layoffs, unfortunately, that means that corporate earnings are very likely going to rise because their expenses are coming down.
Yeah.
So, if you're ever wondering, I'm sure many of you know this, but if you're ever wondering why a stock will rally when it announces it's laying off 10,000 people, which is horrendous for 10,000 people and not great for the economy,
Yeah.
it's because the company's earnings are going to go down. So even if they sell the same amount of products and make the same amount of money, their net earnings are going to go up.
Exactly.
And that is
Mhm.
what drives long-term investment returns. Anyways, I thought I would mention that.
Exactly.
Julina, I'm so happy to say, I feel like we should have a cake and a candle for this one. Goodbye, bear market. Hello, bull market. I know this is a basic chart, but I do want to explain some stuff here. We either have one or the other. There's no in between.
Mhm.
And when one ends, one starts. That makes sense?
Absolutely.
So here we go. I know this might sound a little confusing when we use dates for those people that understand the markets, but here we go. Rest in peace, bear market of 2022. You were born on 1/3 of 2022, and you ended on 10/12 of 2022, where your peak to trough decline was a 25.4% decline in the S&P 500, spanning 282 days.
Mhm.
In comes the birth of a bull market. When? Well, on the same day that the bear market ended, 10/12 of 2022.
Mhm.
We've mentioned this many times now. When did we reach the bull market period? We reached it on 6/8 of 2023. And that now is an ongoing tally. That's just as of when this report was run.
Yep.
For a closing level of 20.0, I would add 2
Mhm.
to 0.02. They didn't put it here, percent on a closing basis. We have been in a bull market. This one will shock you for 233 days. Exactly like we said, Julina, in the January, February, March, April, May video. We've been in a bull market. We just don't know it yet. It very likely started on October 12th, and here is the evidence of it. And you're probably hearing about it on TV, so on and so forth. And Julina, I find it ironic that every hedge fund manager on the planet, every smart, intelligent person who runs institutional money on TV with the amazing credentials that they have told you that the market's going to go back down to 3,000. The market's going to crash. Take your money out, stick your head in the ground, run fuzzy hills. Wow.
Yeah.
How could 80% of these smart people be so wrong? It's media and it's talking point, it's marketing.
Mhm.
It's to get you to click on their stuff. It's to get you to go to their websites, to subscribe to their newsletter because they know something that they know the future. They don't. So thankfully, we look through the noise. We understand the markets. We do a tremendous amount of research. We keep our clients invested. We talk them off of the cliff, the plank, whatever you want to call it, and we make the decisions we need to when
Mhm.
most people are feeling ill watching the markets. So here we are. I'm excited to say that we're in a bull market. I'm more excited to say that bull markets last a very long time. We have a slide on that at the very end. It
And
is
before you move on, I'm so sorry. How do you respond to the investor that says it doesn't feel like we're in a bull market?
right. So in my career, whenever we have a bull market, even if we're 2 years into a bull market, never mind one day, or
Mhm.
never mind unofficially being in one,
Sure.
which is what happens between 0 and the 20% period.
Right. Which is what we just went through.
it never feels like it. So, what ends up happening, just so you know, is the forecasts for earnings, the economy, the world get too bearish. And that bearishness is contagious. It
Very.
sucks you in. And whether it's institutions or individuals, you eventually throw in the towel. So everyone capitulates to a degree. We're going to say this was on mid-October,
Mhm.
and it was overdone.
Yeah.
So should we be in a bull market? Maybe not, but we are in one.
Mhm.
Why?
Yeah.
Well, because people got way too bearish at some point in the past.
Okay. Yeah. That's great.
And too bearish for current prospects of everything: interest rates, the world, society, earnings, uh, generally speaking, roughly around the same time. And in the coming months and quarters, you get to see if all that stuff proves itself out.
Mhm.
More often than not, it doesn't when you're overly bearish. More often than not. And here we are in a bull market showing you that earnings are better than expected. We're still not in a recession. The Fed's just about done. Inflation has crashed. If anything has crashed, it's the price of commodities.
Yep.
Um,
Debt ceiling
and,
gone.
and inflation. The debt ceiling was a non-issue. All the stuff that we've
Yeah.
told people. And really, Julina, in our career, I mean, I know we both look like we're in our 20s, but we both have north of 25 years experience at this point. We have had similar talking points over 2.5 decades.
Sure.
And those talking points are, bull markets sometimes feel like bear markets. Bear markets sometimes feel like bull markets because of greed. But we have to cut out all the noise and actually do our homework and articulate, the various data points, how behavior in the media influences everything, and how we just have to really have a strategy to invest in, rebalance into, take advantage of X, Y, and Z.
That's
And
great.
that has never changed in our career, and it will never change. It's always been this way since the capital markets were created.
Yeah, exactly. I think that's critical for investors to understand over the long term. So thank you.
Yeah.
Yeah.
So bull market it is. More on this at the end of this presentation. Here's, we'll get a little nerdy here and talk about the various factors in the market. What we mean by factors are small cap versus large cap. That's a size factor.
Mhm.
Dividend payers versus dividend growers. Growth versus value. Momentum stocks versus low volatility stocks. So you can see there's really two factors that are doing well this year: growth and high beta. High beta is high risk. So growth is typically quality, big companies, mostly tech, some healthcare. High beta is garbage. High beta is the riskiest stuff in the market. The riskiest stuff in the market last year, on average, went down about 70%. So you just have this bounce that's happening this year.
Mhm.
Is it still garbage? Yes.
Yeah.
And
Yeah.
that's why they call it high beta. High beta is code word for junk.
Yeah. And I would also point out all the way on the left-hand side of the page, you've got dividend paying stocks, which are
Dividend aristocrats, which
yeah.
this is hilarious. But again, we're showing you this over the past 12 months, and it's a weird. If we showed you 3 years, it's very different. But anyways, we'll go with this. Dividend aristocrats are the highest quality companies on the planet. They are companies that have paid and increased dividends for 25, at a minimum of 25 consecutive years.
Mhm.
If there's a sign of quality and strength, it's there. But how quickly people can look past them when growth does well.
Right.
So all these factors, in essence, um, you can own all of them. But if you want to participate with the part of the market that's doing this, you have to sell some of them, right? So sometimes you sell your boring, solid, high quality dividend paying, dividend growth stocks to fund these other themes. In essence, they're all fighting for your dollars. And to get one, you have to sell the other.
Exactly.
So,
Yeah.
anyways, short period of time, it just shows you beneath the surface what's going on in the market. It's really um, it's really one string here that's being played in the market.
Yeah.
Small versus large. So if you are paying attention to your accounts, You may have seen some transaction confirmations come through. I'm talking to you, clients. We added to small caps. We think at the bottom relative to large caps. Smaller companies. Let me explain this. Smaller companies are a little bit more sensitive to the economy. Big companies, when they need to borrow money, they go to the bond market to raise debt, right?
Yeah.
If Amazon wants to borrow money, they don't have to, but they can, and it's cheap for them. They'll ask for 10, 20, 30, 40, 50 billion. Keep in mind, they're almost a $2 trillion company. So that's a drop in the bucket for them. But you can't, in essence, go to JP Morgan and say, hey, JP Morgan, I'd like to apply for a credit line. How much? 50 billion. JP Morgan will say, get out of here.
Yeah.
They can't do that. So they go to the bond market. But smaller companies, they borrow money from the banks. So smaller companies, because of the, what you hear in the news, the economy slowing, so on and so forth, the stock prices of those companies have not come up in essence. They've stayed down. The banking issues that we had a couple of months ago, small companies, as the stock market started to rally up, small caps were left behind. They were just very sensitive. Higher interest rates. If you think about bank lending, higher interest rates,
Very sensitive.
small companies are going to be much more sensitive to higher interest rates. Okay, great. So really, small has not participated with large cap,
Yeah.
the rally, right? And we have reached a level where the valuations of small companies, small caps, relative to large caps has never been wider, ever in history. We love investing in extremes, right? When there's something that's detached from the fundamentals. For us, that's historically one of our most favorable themes ideas is when there is confusion, when there is something that is just detached from reality. And we see that right now. And we've been seeing it for a couple of weeks in small caps versus large caps. We don't love all small caps. I should mention this. If you take the small cap index, here I'm getting nerdy. People are probably falling asleep here. That's the Russell 2000, right? The Russell 2000 is the 2000 largest small companies. It's weird to say, but that's what it is. Half of that index, therefore half of the companies, aren't profitable.
Exactly.
And half of them probably won't be. We don't invest in that. We invest in the upper half, really the upper quarter of the upper half of the Russell 2000. And we started adding to that this week and last week. So if you're a client and you notice some confirmations from our custodian Fidelity Investments, that was us executing orders on a rebalance to add exposure to smaller companies because we think that is such an opportunity for the next, I don't know, 10 years.
Yeah. And I think this is such a great example of how we can lean into some of these opportunities throughout the year.
Yeah. Okay, Julina, if we're right and the betting odds in the market are right and the Fed pauses, again, this is like fun with data and charts. This is how the various markets react to a Fed pause 12 months later. So looking back at prior rate hiking cycles, from the period in which the Fed stopped increasing rates, 12 months later, this is the average return of the various asset classes. And what you'll see here is there's nothing but positive across the board. I really want to focus on bonds. And you can read this for yourself, but if you look at bonds, you have investment grade corporate bonds on average up 14% 12 months after the Fed pauses. So if you've been listening to the presentations that we've been putting out there, we've been screaming that the bond bull market has already started. That's like old news. And if you've been talking to your advisor, we've been articulating to you, we like bonds. I know they're boring, but rates are high. And also in an environment where rates are flat and then eventually they decline, bond prices go up. So you get yield plus price. It's a really great thing. You don't see it often, but it happens.
I was just going to say, we haven't had these opportunities for the last 20 years, except for on nuanced occasions.
That's correct. Yeah. That's correct. So it looks here, whether it's US, foreign securities, mid cap, large cap, small cap, foreign bonds, US bonds, treasury bonds, junk bonds, investment grade corporate bonds, pretty much everything across the board, with the exception of just few sectors and few industries and few styles. Everything looks really good in an environment where rates stop increasing 12 months out. And
And
this time should be no different.
And I'm wearing my glasses so I can see the numbers very clearly, but almost every asset class on this page, which is describing the global markets, is over double digits.
That's right. So I feel great for our clients. If you're listening, you might be shocked how quickly you return to your new all-time high, probably sometime next year.
Oh boy.
Yeah, sometime next year. Outside chance it's by the end of this year. Very confident that it'll be sometime next year. I'm not making any promises. My feeling.
I was like,
Speaking
oh
on behalf
boy.
of myself, not Principal Wealth Partners, but I feel
What a
pretty
way
good.
to transition though into pants.
Oh, how about this one? Bonds are back in fashion, like I was saying. Julina, have you purchased a new pair of parachute pants? We're going back to the 80s and 90s here, or bell
Where are the
bottoms.
mom jeans?
Mom jeans, well, you have high-waisted bell bottoms
Yeah.
and triple pleated pants for men.
Yeah.
So just like the fashion trends of today and yesterday, we have bonds coming back into fashion. And to take that prior chart one step further, if the Fed increases rates by 1% versus cuts rates by 1%, so if the next move of 1% is a cut, right, which is probably going to be the case over the next 12 to 18 months, here is a closer look at price return
That's the blue
of,
bars.
of the blue bars of municipal bonds, corporate bonds, treasury bonds, short and longer term, and the bond index glued together. Almost everything is in double digits. That is price return. So we will leave it at that. Bonds are back in fashion. We talked about bank lending. Credit conditions remain tight. So as you see liquidity, in essence, go down, that's not great. That means banks aren't lending. That will likely change. That very likely has influenced the Fed direction here, and it will very likely influence the next direction of the Fed, which would be cutting. More to come on this. You'll hear us talk more about this in the second half of the year. Real estate, are private investors in trouble? Yes. So here's a chart from Redfin. They are a real estate company. This is national year-over-year growth in investor purchases. You have to be mindful, this is investor purchases, not owner-occupant purchases. This is investor purchases, people that are buying investment property, whether it be commercial or residential.
Okay.
Investors, people buying these things to invest in them, not to live in them. There has been a 49% decline in investor purchases.
Wow.
So something to be mindful of.
Yeah.
In the real estate environment. This is national. This isn't just taking San Francisco or, two other terrible spots that are experiencing, mass outflow of people, foreclosures of commercial buildings and properties. This is a national chart.
And that 49% looks like it's just past the 08 numbers as well in the financial crisis.
A great pickup that's worse than.
Yeah.
It's worse than the pandemic, and it's worse than any quarter in the great financial crisis.
It's amazing.
Now, it's slightly influenced by the red climbing numbers just before it.
Just before it.
Yeah, there have never been more investors buying real estate for investment reasons. I hate to see those extremes because it creates the opposite extreme, and here we are. So I think investors are going to take their hands out of the pot of real estate for a little while and let the owner occupants buy properties. So more to come on that. I think you will see a lot of weakness in private equity. A lot of these companies are scrambling to solve the commercial refis, the short-term financing loans that they've had. More to come.
And can I also say, I think because might be the most anticipated recession, if we do go into one, the markets, I think, are already looking through that.
Yeah.
So that doesn't always mean it's bad for the market.
Absolutely. Yeah. Julina, it wouldn't be a presentation, at least in this environment, without talking about a recession. Here we are showing Google search results over time on the word recession being typed into the search bar. And what you see here is more people have searched for recession over the past, looks like, year or so than ever in history. More so than the great financial crisis, more so than the pandemic when people were at home.
It's my favorite slide.
Yeah, it's amazing. So, the title of the slide says it all: the most anticipated recession in history that hasn't happened yet.
Right.
How effective, how bad will a recession be if it actually ends up being a recession, which
Right. We
we
still don't know.
have technically and still don't have.
Yep.
More to come on that. But again, some of these keywords are just headlines, 2-paragraph stories with recession, what you should do, the next steps, 10 secrets you didn't know. It's a bunch of garbage. Anywho, but staying on the recession here, we've got weekly hours worked has dropped. So
that's a big arrow.
That's a big arrow. And what we show is, you have a combination of things happening, right? You have um, work from home, which generally speaking, for most industries, sectors, and employers, isn't great. The data has shown that productivity has declined, right? The data has shown that people have no way of separating professional life and personal life at home, and that's good and bad, depending on who you ask. But ultimately, the continuing rise of technology is, continuing to put the low-hanging fruit jobs more into the hands of technology and less in the hands of individuals.
Right.
And what you see here is U.S. weekly hours worked for all employees in all sectors, and that continues to decline. And it's a very tight range. So the chart is deceiving, especially by us putting this big yellow line in it. But peak hours were reached in 2020. And that was about 35 hours a week. And they've now declined to 34.3. 34.3 is actually pretty low.
Yeah.
The pandemic, when the world wasn't working for the most part, low was about 34.1. So only about 0.2 away. And what happens there, and what I should point out is, if you run a business, you own a business, you don't want to lay people off. As you look at the finances of your business, good employers will start with, instead of laying people off, shortening their schedule.
Yeah.
So you shorten schedule, and then if that doesn't do the trick for you, then you have to start getting rid of people.
Right.
But this is certainly the first step. So you are seeing a decline in hours worked. Will that turn into a high level of unemployment? We shall see. I don't think so. If we end up with 4 to 4.25% unemployment, for the most part, that's a rounding error to zero. Currently we're still at 40, 50-year lows in unemployment.
Right.
So we'll see. That's something that we'll pay attention to. Here's a slide that we were talking about earlier. It's hard to be bearish, Julina. This is
over the long term, it's amazing to see the amount of bull markets relative to bears, the blue to the orange, right?
Yeah, these are just, looking back at the prior 4, 5, 6 bull markets and bear markets. Look at the amount of time in blue and percentage return and annualized return that you get in bull markets. Provides so much cushion for bear markets.
Absolutely.
You just have to remember this as an investor. I know it sounds silly when things are bad and we're telling you, well, they won't be bad for long. And here's what we're doing to reposition to take advantage of the next bull market. It's because bull markets happen 90% of the time, bear markets happen 10% of the time. I know when you live through a bear market, it feels like 100 years, but it's on average a year.
Right.
And bull markets are on average 8 years.
It's a very different dynamic.
Very different dynamic. And you really, as an investor, you have to understand this. What will get in the way of you having great returns is poor behavior,
Mhm.
greed, the fear of missing out, wanting to buy securities after they're up 8,000%. Usually after an 8,000% increase, there's a 20 to 50% decrease. Buying things when they're down is a good thing to do. We get excited, and I've had, oh my God, thousands of conversations with clients at the firm. We do our best work in bear markets. We get most excited in bear markets. We find most opportunities in bear markets.
And can I also highlight that it's hard to see, but if you see the gray shades on the page, those are recessions.
Right.
And not all recessions fall in the orange. And in fact, a lot of them you start to see at the beginning of the bull market.
That's right.
So just wanted to point that out.
That is right. So you have to remain invested. You have to remain invested. That's really the summary of that chart. Anywho, Julina, what else do you have to say?
I would say it sounds like we are pretty bullish. And I think that sort of looking at our comments, we're going to look for a Fed pause, and we are going to look for falling inflation over the next couple of months and then kind of rolling. And I also would say that the characteristic of the market for the first half of this year will probably look different for the second half. And just like last year, where we took a ton of opportunity for clients, we can still do that in this market for this year. Those are my key points.
Yeah, and I'm excited to say, I mean, this is a big deal. We're in a bull market, and we have years to go. I feel very strongly about that.
But not in a straight line.
Not in a straight line. It's a bumpy path up, but it arcs up.
Yep.
And we will take advantage of the bumps as they present themselves. And I'm very excited for our clients. I'm very excited for us. I'm very excited that the bear market is over.
And I'm excited because I think next month, Bob, you should surprise us and bring in your parachute pants.
Yeah, don't threaten me with a good time. So stay tuned. Yeah. So as always, if you have any questions of us, your advisor, please feel free to reach out, email us, call us. We're always available for you. We'll continue to put content out for you, keep you up to date with what's going on. We appreciate your business. We appreciate your referrals. We have wonderful clients. We have a high view rate of all the content that we put out. There is a way to measure it, and we do measure it. So we're super thankful. We're super grateful for everyone. And without you, there is no us, and we never forget that. So
I agree. Thank you, Bob, for all the comments, as always.
thank you.